you are trading a good business for a worse business. You have to grow at exponential rates as an agentic business because your gross margins are so much lower than SaaS.
And that story is still being ignored largely by the VC community at this point because we all just assume costs will go down. It's not the case.
On today's Top Line, myself and two fellow CEOs dissect the chaos, risks, and opportunity that comes with pivoting a massive company using Intercom's AI overhaul as our blueprint. Why? Because they gave up tens of millions in predictable revenue to bet the entire company on an AI agent named Finn.
Intercom had 5 straight quarters of zero net new ARR growth. I mean, they had a real crisis.
You're refounding yourself essentially, new mission, new values. You're literally re-engineering the business completely.
We cover this and a ton more timely topics for senior go-to-market operators, but perhaps most importantly, we uncover the trap that is waiting for SaaS companies who are still seeing comfortable growth today.
We're screwed in 2027. We're absolutely dead in the water if we don't.
Welcome to Top Line. Hey everybody, it's Sam Jacobs. I'm the CEO of Pavilion, and you're listening to Top Line. I'm joined by my co-hosts, AJ Bruno, the CEO of QuotaPath, and Asad Zaman, the CEO of STA, Sales Talent Agency. Today on the show, we're going to be talking about an essay that has been making the rounds of social media, written by Intercom returning CEO Owen McCabe. It's about how Intercom turned around the trajectory of that business and now has built one of the fastest growing AI native, we might say, stories, although maybe I'm bastardizing use of the word native, in the ecosystem. And Intercom is now past 400 million in ARR, and the platform and the product they built on the back of AI, Finn, is north of 100 million in ARR and one of the fastest growing agents that's out there, particularly in the customer success space. And Owen had some provocative things to say in this essay. We're going to break it down. So gentlemen, welcome to Top Line and start your engines.
Over the last couple of weeks, the main theme in our ecosystem has been these SaaS companies and the beating that they've been taking in the public markets. We've discussed how in a 6-month period, they've lost close to 600 billion in market cap. We've discussed how just in the span of a few weeks, 300 billion of that went down. Most of it because of features and functionality being announced by Anthropic, and that making investors question the viability of entire SaaS categories. This reset has been with a broad brush. Part of it is that while AI companies have been gaining all of this momentum, the criticism on SaaS companies is, well, you've said you're doing all these interesting things, but it's not showing up anywhere. It's not showing up in your growth. It's not showing up in a place where we can look at that and say, your future value is secure now as a result. Instead, we actually need to put a discount on your future value because we don't see it. And we've all had the conversation of what do these companies, and not just the public ones, but the private ones, what do all of these companies that were born pre-AI have to do to be viable in the future? What are the set of things they need to do? Where will it show up? And we've had that conversation. But we don't have many examples of AI SaaS companies that really figured it out, right? Like there was re-acceleration happening at Palantir, but do you even count Palantir as a classical SaaS company? You know, I'm not sure.
Palantir is not a SaaS company. We can answer that.
Databricks, you could say is a SaaS company, but it's one example. And so we're searching for examples and trying to figure out what's working. And just right now, Intercom CEO wrote what I thought was a really interesting article about their journey, where he showed how Intercom had reached a point where they were in single-digit growth. And now they have upwards of 35% growth driven by an AI product that they've built and taken to market and the lessons that they've learned. Sam, as you were reading this, how did it just land with you? You know, we've been talking about how maybe these SaaS companies can't figure it out. Maybe it's too hard for them. But just consuming this, what feeling did you walk away with? What were your first thoughts when reading?
First, there's a selection bias. You know, there's a fundamental attribution bias. The person that won writes the article about how they won, when many times people don't really know why they won. And there's many companies that might have tried something similar and weren't able to pull off the very impressive feat that Intercom's pulled off. But then I have many voices inside my head. That's why I take medicine. And there's a countervailing voice Sometimes they tell me go get Asad and kill him. That's where the lithium comes in and a bunch of other antipsychotics. But that's not what we're talking about today. That's not what we're talking about today. Today, the point that I will make is there's a part of me that is a little bit dismissive or negative or cynical, and I don't like that part of me sometimes. I don't want to just be the person saying easy for him to say. Well, let's look at what he actually did because it's quite dramatic. What they did. I have three thoughts. So this is the second thought if you're following along for the outline, dear listener. So the first is easy for him to say, but a little bit more articulate than that. The second is, but what an impressive feat. And let's look at what they did. And it was a burn the boat strategy. It was burn the boats. It was, I think he said he gave up 60 million of contracted seat based ARR. They moved all of their marketing, every bit of energy. They staffed the team that was working on Fin. And so the point is that they just pivoted the entire organization. And yes, maybe they had some early signals, and yes, maybe they were, but mostly it was strategic bravery. And I've been thinking about this a lot today as we thought about recording. And part of it is we didn't have a choice. We didn't have a choice. His perspective, Owen's perspective is we were going to die otherwise. So we have to do this. We have to burn the boats. The reason it's so hard is because they gave up 60 million of ARR. They had a multi-$100 million business. And this is why the innovator's dilemma exists, because you have to be willing to say, I'm going to pursue something entirely different, even if my numbers go down in the short term, even if I don't present the story in 2026, I will be able to present that story in 2027. And they went all in. He was all in on building the agent for customer success, or I guess for product experience. I'm not exactly sure how he would define it, but the point is they went all in on this product on Fin, meaning marketing, sales, redesigning the organization around this initiative. And that feels quite brave. And to your point, Asad, I know you find it inspiring, and it is inspiring. So that's the second thing I think. And the third thing I think, because I am the profitable, efficient growth guy, is I'm very interested in agentic math these days, because we have to understand that yes, the growth is amazing. It really is. And I don't want to diminish it, but you are trading a good business for a worse business, just so that everybody understands what's happening. You have to grow at exponential rates as an agentic business because your gross margins are so much lower than SaaS. And if we believe that customer acquisition cost is not necessarily going down, and we can talk about whether we think it's still going down or maybe it's going down for some people, maybe if there's huge word of mouth like with Fin, then maybe it's a low CAC. But you have to understand, everybody's listening has to understand, this is not software as you understand it. Proactive, suggestive agents that tell you, hey, I've been thinking about you, Aslet, and I think you should do this. That's an incredible, magical experience that is extremely heavy on compute and extremely expensive to deliver, and is not SaaS. It is not 90% gross margins. And what does that mean? That means if CAC remains the same and gross margins are cut in half, you are going to need massive retention. You're going to need much stronger retention cycles to recoup your investment on that customer, and you're going to need higher growth than you would expect during SaaS. I'm not trying to rain on the parade. I'm just saying you can't just say growth is great. Growth is great. It is great. It is great. But these are different businesses. This is almost like trading a software business for a manufacturing business. And everybody that's listening has to understand that maybe the model cost will go down. Maybe cost of compute will go down. Maybe the cost of electricity will go down. And we can get back to 90 or 80% gross margins. But I just think it's interesting. Everybody needs to understand these are not the same businesses. They're moving from a really, really, really good structural business to a worse business. That said, it's incredibly impressive. And I think the most important point is number two, burn the boats.
When you say that we're trading this business for that business, sometimes there's one sort of trade is like you sell your house for another house. But then there's another one where like I'm trading something for something else, but the thing I have is just not going to be viable anymore. When you trade your house for another house, it's a better house maybe, right? But it's like that was a house too, and it'll still be there decades from now. Well, in this instance, it feels like the better business model that was SaaS is not going to be an option. Like it's going to be a depreciating asset over the next couple of decades, if not just within the next decade, like hugely depreciated. So it's like I'm moving to a tougher business model, a tougher business to build and run for sure. but it might be the only game in town. Would you
100%.
agree with that statement as like a follow on to what you said?
Absolutely. What I absolutely agree with it. You might not have a choice, but I just think it's important because we
Mm.
see, the famous VCs talking about massive growth rates and acceleration, and it's good, but just understand 35% growth on a SaaS business is better than 35% growth on an agentic business because of gross margins. Just
Compared
understand
historically.
that.
Yeah.
No,
I,
I'm
I'm
saying not historically, I'm saying the cash flow generation. We're in a period of enthusiasm and mania in the markets, right? So discounted cash flows and fundamentals aren't perfectly priced right now. But at some point, people will truly evaluate the structure of these businesses. And I'm just saying that, yeah, you're going to have to grow more quickly than a traditional SaaS. SaaS 90% margins is a freaking beautiful thing. It means you basically don't have to worry about margins. Agents do. They really, really do. And I've talked to so many CEOs that are like, we want the thing to be react or suggestive, proactive. We want to tell us that here's what you're supposed to be doing, and I've actually already done it for you. And that is massively front-loaded expense on behalf of the company that's providing that service.
Sam, I have taken my medication today, so the voices aren't talking to me
So
either.
you have fewer voices than I
This
do.
is fewer. My thoughts and feelings will be measured and calculated in
There
this
you go.
conversation. So QuotaPath is instituting Fin this quarter. By the end of the quarter, we'll have it. So we're actually going through it. And I've been an Intercom customer at two companies for the last 10 years, and I've seen the organization. But at the heart of it, it's chat. It's support chat. Intercom's never had reporting, ever. They've never had reporting out of the box. And I think it was always an interesting thing. And today you don't need reporting out of the box. In fact, I have a friend who loves HubSpot, uses HubSpot CRM. It's a small business, and HubSpot's trying to get him to upgrade to enterprise, which would be just reporting. He's like, I can get reporting from it. Reporting is so commoditized. I can get that from any LLM.
Let me download my pipeline. I'll put it into Claude. Claude will give me all the BI I need. I don't need Looker plus a million other things.
And so I asked him directly, like, okay, what point do you replace your CRM with Claude or whatever? He's like, oh, I won't do that. Like, okay. So everything around is being commoditized, but the core piece of it, the core fabric of it is still the important part of it. And I think reading Owen's monologue, which also, by the way, this story is being written. He has told this story multiple times. He's went to the Notion AI conference and talked about this. My CPO said he was there using very colorful language around this. So this is something that he's been talking about for quite some time, and the burn the boats analogy is apt, but I read it and I'm like, these feel like they're such scare tactics and when you read them, and we do have an innovator's dilemma, but it doesn't mean you're burning everything across the entire organization. I think there's a few key things that as founders, as operators, we really, really need to look at. First and foremost is that Larry Ellison tweet yesterday around data. Data is your moat, and understanding that that is still a core central part of what will differentiate in the world. Now, we hear terms like MCP. I don't know if you all know what that term means, but this idea that our data can connect to another partner's data, and that is what the LLM uses as context and actually can read, is very, very important to our success. The second thing that I think about for this is the pricing model. Sam, you talked about this in last week's episode, how pricing is going to be so important. And Owen is out there talking about the outcomes based pricing and making that change. Let me be real. That is marketing fodder right now. It is truly marketing fodder. If I'm a CFO at an organization, I want predictability. I am really getting a little skeptical and hesitant about this credit usage because things can get out of control really fast. Let me bring another example of where this is causing issue. Claude Business versus Claude Personal. One is $150 a month and one is $200 per month. The personal is $200 per month. The business is $150. The personal will get you 4 times the usage than the business right now.
Interesting.
Claude Code and these organizations are hitting the very thing that Sam was talking about, which is the margin challenge and the margin. And story is still to be written and still not figured out and being ignored largely by the VC community at this point because we all just assume costs will go down. It's not the case. And I think that that's the part of this that's really interesting. Ultimately, the spirit of Owen's messaging is 100% correct. We are in this very different time, and you really do have to make massive, decisive changes to your business, but you have to be very intentional and you have to be very measured. And that's why I'm glad I took my meds today.
Intercom is in the category where there are so many companies that are doing really well, right? Like support is one of the great use cases of AI today. AI requires areas where you can use objective functions where there's lots of data, code, fairly binary thing. Most of it is online, all of it is online. Support is another area where it's closer to being binary than not in many cases, and there's at least components of it that are fairly binary. And there's lots of data there as well that you can use. And so it's doing quite well over there. And it's kind of crazy how many companies there are that are doing 100 million in revenue in support, right? You've got Sierra, you've got these guys, you've got a lot of companies whose chatbot is doing well. If you were at Intercom pre-AI, what would your analysis have been of the future viability of this business? And then like something changes in the market and look at them now, right? So it's like, don't give up so easily in life is I think an important reminder when you hear these stories, because like things change, opportunities present themselves, being in the field and like being open to finding them and then doing the hard stuff to capitalize on them is the game. It's not supposed to be a straight line to the top for
The
everyone.
word that Owen used in the article that really was resonated well with me in this point, Austin, was creative destruction. Uh,
Yes.
That's the part that I really think he nailed it on that. And so the way I would think of this is that there are a lot of companies that will try to do all the right things and it won't work for them because part of this is having the right product for the right space. And you might change your values and you might, change the way that you talk about yourself in the market. But if you don't find the right product for the right market, you don't get product market fit, it won't work, right? So there'll be a lot of companies that say, we did all these things he's saying, if we look back 5 years from now and it didn't work out for them. But I think it would also be fair to say for the ones that it did work out, probably had to do all these things as well and find product market fit as well. And probably a lot of these things increase your probability of finding product market fit. And these are really, really hard things to do. I think, AJ, I do think that it is more burn the boats than not. Like, I think when I look at organizations, especially like the ones that are a few 100 million in revenue upwards, there is a deterioration in talent density that happens in these organizations that makes it really hard to change and meet the moment. And I think right now we're all just trying to meet the moment, and it requires some really severe action. One of the structural advantages he had was he was a new CEO essentially, right? Sam, he was the old CEO, he went away, he was ill, he came back, and he's like, when you're the new guy, you can say, I just don't like what the other person was doing. Here's all these radical things that we're going to do. It's easier for the new person than the.
I
What
don't
do you
think it's
think?
just that it was the new person. I think it was that he was the founder. I think it's not dissimilar from Steve Jobs coming back to Apple. It's not dissimilar from Howard Schultz coming back to Starbucks. It's
Founder mode, baby.
well, but it's this is my company. Whatever the ownership structure is, like this is my baby.
If it's going
And
to
I
burn,
I
I'm going to make the decision. I'm willing to risk it all. Like,
Well, the
kind of
fact
like,
that he wasn't the CEO at the time and then was coming back to it, it's almost like you're building a new company from scratch, and coming from that lens gave him the opportunity and the bank and the customers to be able to do that, because the board obviously put their bet on him when he came back to do that and said like, "Listen, you gotta do what you gotta do." So he got to be he had a window of time to be super objective about his own business with a bunch of people that he probably didn't hire. There were probably a lot of people that he did hire. And so it allowed him to be like, "You can create a brand new startup, and whatever gets in my way, I'm just gonna have to push through. There's gonna be no red tape on this, and we're going to do this."
it's so intense, some of the stuff that they did, because like when you think about a business that on one side has hundreds of millions of dollars of revenue, and on the other side, there's this little thing that maybe has a few $100,000 worth of revenue. And you're basically transitioning all effort and energy towards this small thing with belief that this is going to work. And if it doesn't work, so be it. I would let it die as a result. Like that energy, it's like, it's so hard. Like the wherewithal you need to be able to do that, because your existing product stops getting R&D spent. That means your competitors in market have better things to offer your customers. So your win rates are going down. Your churn is increasing. We discussed this, both of those things will happen. You are willing to like stomach that. You're
Yeah.
adding on pricing change and losing another 60 million there. So you're just like getting beaten on one side, and you have to have belief that this thing is going to work. And I think it's so hard to go to sleep like that. Like I have so much respect for that. It
Well, here's
worked.
one thing to add to this also that's not in the article, but is a really foundational point to the value of Intercom, the values of Intercom. And I'll give you a hint on what it is. His spelling of his name will give you the hint on on the core belief of Intercom, which is if you don't know how Owen is spelled, well,
How would
good
you
luck.
think?
Yeah, you could guess and you'll never get it. It's a Irish, spelling, I'm guessing it's Gaelic, but
It is
it's I
Gaelic.
Intercom's an Irish company, and I remember when we first brought on Intercom in 2015 at Trendkite, we like, that was the big part of Intercom was like, "We are from Dublin. We're in Ireland," and that is, like, who we are and core to our success. Uh, Sam, even when we went to,
Why does that matter? Like I don't understand. Why is that?
because you're having a founder go back to a company that he founded. Imagine you have so much, like, pride of Toronto, and you built this thing, and the people that you believe in are all in Toronto, and now you're coming back, and you're kind of like it's a different company. You have to think about
Maybe
this.
to AJ's point, maybe it's a story about how there's not that many great Irish companies besides Stripe and Intercom, and I'm not going to let this thing go under. We fight. Irish people fight. We fight Great Britain, and we fight the bastards
With the
that want to
belief.
put Intercom
Yeah,
down.
and so you kinda have to burn the boats. There's like a different feeling from that, right? Like, that's a different there's definitely something in there.
I think the way that it probably works is when you're bringing in the new crew. Like, if you think about like the couple of things that need to happen, there's the people component to what he's spoken about, right? Like, we hired and fired against this strategy. And so there's some people that he's trying to change the hearts and minds of. There's some people he's realized I can't change the hearts and minds of them, or they don't have the skill set that I need. And they're the new people that you're bringing in. I think that energy and that enthusiasm is very, very intoxicating for the people that are coming in. It does change some hearts and minds, but you also then need to manage the trash of the existing where it's not working. And that's the hardest, that's the most heartbreaking. You now have to become a different company. You're refounding yourself essentially. New mission, new values, new ways to hire, new way to spend money, new way to talk about yourself. Like you're literally re-engineering the business completely. What do you think? He spoke about values changing, hiring changes, mission changed, board changed, R&D spend changed, marketing focused on the new product only, a lot of pricing changed. When you think of all these things and you try to say, okay, I'm reading this, I'm a SaaS company founder today, I'm trying to be Intercom too. These are all the things I need to do. I can't do them all at once. So I'm like, which one do I do first? What's like the most important stuff here? Like, what's the, yeah, and I like, and we'll write about this, but like, this had like a minor impact on where we went or what we did. And this other stuff was like, this was the huge stuff.
Maybe it speaks to where I'm at in my life, but the number one thing that you need is board support, especially if you're not the majority owner of the company. But even if you are the majority owner of the company, if the board has budgetary approval, if they have, different kinds of major voting rights, nothing starts without you going to them and saying, I need your back and I need your support. And even if you're the majority shareholder, there's just such a difference between the people that are entrusted to for corporate governance, even if they are minority investors, right? Even if they don't own the company, but if they're ambivalent, if they're cynical, or if they're like, I don't know, we really don't think you should do this. That energy impacts the confidence that you have going out to the organization. If you have board support, enthusiastic board support, if you can go and they say, Owen, you got this. You're going to do this. Let's go. We'll help you. We'll help you. You're right. You're right. And don't let anybody stand in your way. That is what you need. And if you don't have that, at least speaking for myself, when you try to get up there in front of the organization, you just know that you're not facing just one adversary, so to speak, or constituency. You're not just trying to convince your customers and your employees and other stakeholders. You're actually trying to convince the people that are investors that own a chunk of your soul, so to speak. So I think nothing happens unless you have full-throated board support. But again, to the point of what we were saying earlier, you don't bring back the founding CEO if you're going to make small changes. This isn't, manage,
He has
set
board
it on
support.
autopilot. They came in saying, go blow some shit up.
It seems like he had some other sort of control though, right? Like, because he was brought in, but then he changed the board.
People out there don't always understand, particularly if you don't have a board, the impact. It's not just the formal governance. It is these are
Your
the people
mental
that are
health.
supposed to be supporting me. And if you feel like they don't believe in you or they're not supportive of you, it's really hard to give a full-throated, impassioned halftime speech to the team to go win the game. If you feel like the people that are really the puppeteers, of like the global economy, the people that that have the purse strings are questioning their belief in you, it definitely impacts you. It definitely impacts you. And then I would say the next thing I think of is just this is why it is impressive. It's incredibly impressive, and he deserves to be proud, regardless of my comment about margin, is because there's a fear, there's a hesitancy that becomes part of a larger organization that just, well, I don't know, I don't know. And then, well, that's going to create extra work for Joe, Sally, and Betty, and their whole departments. And how are we, well, hold on a second, hold on a sec. How are we actually going to do this? Slow down, slow down. And it is hard sometimes when you're the CEO to remember it's your company. It's your company. You don't have to listen to those people. Listen, I still think it's harder being a CRO. You're never going to hear me change my tune on that. Being an operator reporting to one of us is harder. But the hard part about being a CEO is sometimes you just have to say, I'm sorry. Yeah, I'll own the decision. I will be wrong. You can talk smack about me. You're gonna anyway. But this is what we're doing. And you're either with me or you're not. I need to know now.
Owen actually talked this is actually a really good point because this is something that my CPO said that Owen actually talked about the Intercom relaunch and how the public piece of it and everyone was laughing at them and thought how ridiculous. But the reality was that Intercom had 5 straight quarters of 0 net new ARR growth and was approaching negative growth. I mean, they had a real crisis. Literally have to have that shift into a wartime focus of like, we can't do everything. We have to go all in somewhere. We're going all in on AI. And that radical focus, like created clarity. These are the things that we hear about all the time. And I shared that article immediately after you sent it, Asad. And I think the board point is very, very good, Sam, but I will actually extend that to your management team as well. CRO, a really good CRO wants predictability. They want clarity. They are hearing from customers. These are the features that we need to have. These are the things, these are the buttons. They are at odds with exactly you as a CEO from a vision standpoint because customers are not going to tell you that they're going to I need AI intercom. I need Fin. They're not going to tell you that. And so that's the point where you as a CEO from a vision standpoint are going to have a lot of comments that will feel like they're anchoring you or weighing you down. Now, when you talk them out, okay, but that's at the trade-off of the resource of putting everything we have into our AI native product. Do I wanna do that? And it's a real conversation that we have, and I sent this out to everyone and, like, had kind of a back and forth at 9 p.m. last night on this very thing. That's how important this stuff is.
What are you thinking about for quota path? It's highly relevant. I would except that you're not facing, you were
We're not facing
growing.
the growth issue. Yeah, and
Yeah.
so, like, but that makes it more of a crisis, an unseen crisis, though, Sam. The board can be happy with our 50% growth year over year and continuing to do it, to me, I'm like, we're screwed in 2027. We're absolutely dead in the water if we don't like fix this now. And so it's a really hard thing to reconcile with your team because you've given them marching orders and focus and clarity on focus, and they can't get distracted by 2027. They're, Ryan's worried about Q2, Q1 and Q2. He's worried about hitting
Well,
a
I mean,
target
that's the
number.
point of this whole thing is like if you're not willing to tell Ryan or somebody like, yeah, we're gonna miss Q2. I'm willing to miss Q2 for 2027 and 2028. I want to have a company in 2028. So yeah, we're rewriting the plan. I'm lowering the goal. and we're moving everything into what's the name of your agent's
Uh,
name?
I don't know if it's been announced yet, so I'm going to talk. I
Was
don't.
it was something was
It was
so
anything of my
Yeah.
Kelly
it
to
was like
Travis
it was
almost just
Ollie, it was the genie in a bottle, and you're like, that's kind
no.
of
That is not it.
problematic.
Nope, that is not it. I will announce it here. I will be very, very excited about the announcement. We'll see in the top line newsletter. All of that to say, you're right, Sam. It's even harder when things are going well. I'm nervous for all the companies and even AI Gen 1 companies where things are going super well and they've got to reinvent themselves because Claude or ChatGPT are just going to commoditize them.
Does writer need to exist? Does the company writer need to exist?
No, but they built their own
That
LLM and they've said they're like crushing it and blah, blah, blah. But it's
Yeah,
exactly
they said
that
they built
point.
their own LLM, and then and when May was saying that, 3 years ago, I'm like, "Oh, that sounds so cool and interesting and smart," and now you're like, "What the hell? Why the hell are they doing that?"
Who's buying nine? Like who's buying nine?
It's not
And
better
like,
than 5.2 on ChatGPT, I can tell you that.
yeah, I think the companies like one of the features in their journey was their growth. It was so bad that you can actually create this energy towards like we got to do something about this. And I think the hardest ones are where your growth is decent. It's not like if it's amazing, something's really working, right? Like if you're tripling every year, like if you maybe don't burn the boats, like maybe just think about like something's actually working, you figured it out already. But if you're like at 30, 50, 60% growth, now what? Like STA was on the rule of 40, 63 last year. What do? We're kind of comfortable a little bit, right? Like we're doing decent. Like, do we want to rewrite our methodologies and approaches and design our org? Like that's really hard. And everybody is in organizations that are doing decently. It's even harder, I think, to do what these guys did. And so it requires that much more conviction, that much more energy. And I do think it's the job of the CEO to have this foresight and create urgency and push. But pushing is hard, right? Like, because in every business that's doing decently, what do you have? You have more work than people can do that work. You have people that are stretched. You have people that some like change, some don't like change. Every org has people that have different comfort levels with change. And then you try to do something super significant like this, and it's hard to bring energy around that thing.
I just paid the Intercom fin bill. I just like actually looked at it. It's still a problem. As much as they think they have that fixed, they have to overcome a huge change. And there's going to be a lot of players that are going to spring up who do 70 to 80% of what Intercom does a lot cheaper. I don't think people are still.
What it would Well, tell us what the bill was. I mean, don't bury the lead here.
So we paid somewhere in the eight figures, low eight figures for Intercom last year. Okay.
8 figures.
8 figures?
No, 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 no. Sorry, I'm going the wrong way. I just
The
lost
point
all
was wrong.
credibility out there with all of the audience. It's
Burn multiple of like 99.
I am really burning the boats over here.
You're just like, "Fuck it. I don't want a balance sheet." Alright, did you mean 6 figures?
five five figures. We're
5,
going
okay. Alright,
low
no
five
biggie.
figures.
Fair enough.
If you do the monthly bill for what it's going to be, it will be 4 times the amount of our yearly bill.
15 grand to 60 grand.
Exactly right. And that's not acceptable.
Well, I don't know if that's not acceptable, right? Like, so the first thing is that
But did it
I think
replace a support person? Is that what you're
Right,
going to
that's what
ask?
he's gonna
a
say.
few things. There's a few ways of looking at this. The first is growth right now does get a higher multiple than margin because of the moment we're in. Because growth kind of means it gives you room to run a little bit in the market right now. If you play this out, if you're an AI company, the faster you grow, the more capital you can raise, which is a core resource required for you to be able to keep fighting, keep twisting, keep turning in a market where it seems like the defendability of anything we do has diminished into this minimal like level where like you could have a product this year that's doing well and next year like Chris is such a beautiful example of this, like one of the fastest growing companies in history, no one's using it anymore, like it has been
We're moving off of
completely
it.
sidelined to a Claude code. Like that's how quick things are changing now. Would you say that Cursor has no shot? It's like, I don't know, Cursor could come back with something super fancy and have another like go at it. That's the market we're in. Volatility. I wrote about this. Volatility is the steady state now. It's not once in a while. It's like everything's changing all the time. You got to be on your toes. And so capital gives you the ability to fight, and growth gets you access to capital. If you're an old school SaaS company, growth proves that you have a shot at existing in the future world. If you had a zero growth company that had like 80% margins, I think that's a much tougher position to be in as an old school SaaS company than if you had 10% margins and 80% growth, right? Like that, there is a, because now if you're being
I don't think it's
acquired
just
in the,
it's not just now. Growth is always going to be worth more than
yeah, but I
profit.
think the multiple has increased. Like there's
Uh,
always a higher multiple. I think that multiple is going up now. So I think, yes, these are inefficient businesses. Yes, we are hoping that costs come down. We are also like not really reporting on cash correctly because forward deployed engineers are on R&D spend. And if you put that, like CAC is like out of whack right now because really it's more of a go to market spend the way that these companies are doing it, but it sits in R&D. And so I think there's a lot of inefficiency in these businesses, but you're willing to deal with that inefficiency for the sake of growth because of what it means today, and how it enables you to fight. So then come to pricing. Okay, so pricing is obviously not perfect just yet, but are you better off as Finn being early to the changes, learning as you're doing? Because so much of this is like having to learn how to do this pricing correctly, what guardrails, what scaffolding to create, or sticking to something that actually is going to make your margins much worse. Because the reason this sort of pricing works is it scales up and down based on usage, and usage is driving inference costs, which is why their margins are bad. So if you don't do this, you're destroyed. Like you just don't exist as a business. You might as well take the hits and figure it out than not. And yes, the promise of these technologies is that you should need less humans. And so you're going to take human spend and put it towards software spend, and that's why it works. If it's not doing that for you, then you've bought a thing that doesn't work and you should really think about using it.
Well, Asad, if you're out there listening, dear listener, and you're thinking, how do I get more growth? Apparently, you can just hit me up in QuotaPath for a $35 million contract, and
Well, what's the point?
I'm there for you all.
I got this.
I mean, this is part of why I know you love Derek Thompson right now, Asid,
Mhm.
and he quoted William Goldman, and it's true. Nobody knows anything, and I think it's really important to underscore this. It's okay to offer an opinion, but if you're confident and obnoxious in your opinion, you should
Hmm.
be discounted because nobody knows.
How do you balance that with the conviction a CEO is supposed to have about what needs to happen? Like, because it is a little contradictory, and I believe both of these things. I'm like, who the hell knows where this is going? But like, you also have to have conviction and do things. And so, how do you balance that?
I think you have to try and you zoom in. You're like, this is what I know about us, regardless of what happens in the outside world. Well, AI certainly doesn't sound quite as deflationary as everybody's pitching to us.
Not at all.
Now it doesn't mean it's not deflationary at all. $60,000 for an intercom agent might be good if you can replace your entire CS team, AJ, and you have one person that's an orchestrator, like a CS engineer that's running all of these agents. But if that Fin agent is anywhere close, like if it was like, well, that was just one instance, and that was like this many requests were handled, and actually it's only handling 20% of the volume. And if we wanted it to handle 100% of the volume, it would be $300,000 a year. All of a sudden, you're like, well, it's certainly not going to wipe out all white collar jobs. There's definitely going to be jobs that humans might still do because actually it's kind of expensive. And then again, the counter argument is, well, the cost of models is falling. It's like, but everybody wants to use the latest models.
I think the cost of models falling is a really tough one for what you just said. Why would you not want the most intelligent model most of the
Of
time for most of
course.
the
It's
things?
like, no,
Like,
I want the dumb person.
yeah, like when do you go out hiring looking for the dumbest person you can find? If this is supposed to replace labor spend, no one goes out hiring the stupidest person in the market. And so I don't think you go out looking for the dumbest AI in the market. What I am realizing though is I think that cost per human in a business is going up. So I think the number of humans we need goes down. But if we believe that what you get out of AI is dependent on the caliber of the person using it to some extent, then that means you have a bigger incentive to go and get the best people. So it drives demand for the very best people. The very best people are what? Somewhere between 5 and 1% of the people that can do any particular job. And so that supply stays somewhat flat, but demand towards them is increasing. So price goes up. But what the other cost associated is every human is using a lot of AI. If you're an engineer, they're using
Yeah.
thousands of dollars of AI every single month. And then that is going to happen in every function of every sort. So that the blended cost of that human pops up.
AI is a young person's game, and established companies are competing with startups run by people in their 20s working 12-hour days and then 995, whatever it is, like, or 997, sorry. That is a big disruption. So your point around like knowing whether the talent is there, you don't know what's what when you're interviewing people and understanding it, and experience and even referrals and references are all out the window. So it's
I disagree. I think it is what is 1%? What are the top people at any given moment? That changes. So we point our energy towards like a younger, more AI native person. And so that group becomes the 1 to 5% in that moment. And but maybe before that group was like people at a more senior level with more skills. So the group changes, but it's still a finite group. And we will learn what the right group is. There's enough experimentation happening in our ecosystems for us to be able to say, across thousands, hundreds of thousands of hires being made in companies that are trying to get the best out of AI, where's the juice coming from? And we'd be like, oh, it's actually these youngsters. And it's like, this is what they look like. And this is where they come from. Great. That becomes the 1 to 5%. And then over there, price goes up.
The point that you made, Asad, and I'll just give a personal anecdote, right? So we've all been doing stuff, right? We've all been like trying things out in AI. So now I've got a Lovable account. I then had to set up a Cloudflare account to host my new domain for this app that I built. Then I needed this DevOps account on Alestio and I had to set up an AWS server. My point is like I'm entering my credit card like in a lot of different places that I'm kind of like losing track of. And that's just me. And when again we talk about this deflationary pressure of AI, but what I'm seeing, exactly to your point, Asad, is every single human, every talented human is actually going to need large amounts of compute, because they're going to be the ones pushing complicated tasks. They're the ones that are going to be knowing all of the different capabilities of different tools. And, yep, have I hit usage thresholds on Claude and on Lovable? Absolutely. Have I re-upped my tokens on Lovable? 100% I have for my vinyl record collector social media network called Crate. Thank you very much, crate-vinyl.com, crate-vinyl.com.
Sherry, they're going to be so
This is
excited
not,
about this.
there's no free lunch and there's no massive deflation that's immediately imminent because we're not trading $100 for $1. We don't even know what we're trading yet.
That's why it's so important for companies to have resources and scale of some sort. Like the hardest journey right now is for an unprofitable sub $3 million SaaS era company or sub $5 million SaaS era company. You need some like decent money right now to play with in this market. Like you need either a couple of $1 million of profit in a year to give yourself like a fighting chance, to try things, to do things, to hire new people that you never hired before, to be able to digest the cost of these things. Even if you are like a SaaS era company that figures out the right product, how do you pay for the inference? Every recruiter at SDA will probably have like 10, 20, $30,000 worth of inference costs in the next couple of years, like maybe within the next year or two. That's a lot. That's like a mini assistant for each person. That's like basically if everyone had an EA, half an EA.
There is not enough compute. We don't have enough power plants. China does. We do not. The regulatory pressure on it's not going to be easy to build new data centers. Like we are not. There's no compute coming online. It's the price of inference is going to go up.
Pulling this thread just a bit more, there was this block layoff announcement. Jack Dorsey basically cuts half the workforce, give and take, and says, this is because we're using AI so well. We're doing well. We're in a position of strength. Profit's good. Revenue's good. We're happy where we are. We just don't think that in the future we need all these people. Stock pops up 25, 30% at the minute this announcement is made. Everybody starts talking about how this is creating the room for other public CEOs to do similar things. But the criticism of Block is that when you actually look at how many people they had versus their revenue and versus their profit, and compare them to even like private companies that do similar things and are multi-billion dollar organizations, it felt like a very bloated organization. His organizations have generally felt quite bloated. That's why Musk was able to come in, cut 80% of Twitter, and it still works really well. It is kind of shocking, by the way, that Twitter X works as well as it does. It has really 30 proper engineers right now, like 30 key engineers running this stuff. It is kind of crazy, by the way. And then you've got Block that's doing what they're doing. And people have to somehow like compute when they're moving in the market. If you're an operator moving around, you're trying to figure out what signals are real that this company is doing well with AI and what's just like, magic hands, because you don't want to land up where it's magic hands. You want to land up where it's real. How do I compare these two situations and inform how I navigate a market? Sam, you talk to executives all the time. How do I take this information into account and inform myself?
Actually, Austin, you posed the question, so I'm going to punt it over to you
Yeah,
on
what
this
do you
one.
think, Asad? How do you do it?
I think you have to look at all the things you guys spoke about a bit earlier, around the key metrics around growth and churn. Like churn, I think is the most interesting one. Is it working if you don't have higher churn? Probably not. Is it working if your margins haven't gone down? Probably not. Growth is easy to show like, hey, growth, it's happening in growth. But like the more nuanced ones seem to be like margin goes down, churn goes up. Something's
Churn goes
working.
up because you're transitioning people off your legacy platform.
Yeah, it just feels very contrarian and controversial to Sam's earlier point, if you have a board and like you're telling this narrative, you're coming in and saying like, "Hey, we're celebrating churn. Yay."
You gotta get your KPIs super dialed. It has to be much more specific than
You have to
churn.
be
It has
very
to be
predictable about it.
non-ICP customers are churning, but ICP retention's going up and spend per ICP customer is,
And you
through
remove that from the data
a
and you have that its own slide and you can actually have an up and to the right slide on that. Like, here's what our
you better
target
be
is.
right. You
Yeah,
better
you
be
better be
right.
right.
And margin probably is just broadly going down though, right? Like, but margin's probably not that nuanced. It's like going this way.
Well, I mean, you wouldn't show margin, you would just show token usage or whatever. There's gotta be this is why you need companies like Orb or Paid or something because it is true that calculating the back end billing, it's not as straightforward as I'm accessing a broad LLM as a vendor and a user in a specific account is using the platform, it's not straightforward that like you instantly get a report that's like this token goes to that person on that dime for asking that question. And my point is, you should be able to show like usage of AI compute is going up. So yes, margin is lower for that revenue stream, but the revenue should speak before the margin compresses. I mean,
Yeah.
you should be able to split out the revenue streams
I
from
think you also at this is where AI can be very helpful. You have to be able to tell the narrative and find lookalike companies. Intercom is not a good example, but other companies that are in your market that are doing this and are successful so that you can really have clarity into what the target looks like and what you can tell to the board. It's delicate.
On this, like Jackie in our top line slide had a question around there were a lot of SaaS companies that were built just selling to other SaaS companies. And that used to be kind of like the best SaaS company, right? Like the fastest growing, like they would do really, really well. Are they the opposite of what they used to be? Like they would be the hottest SaaS companies before, but they're like worst off right now because they're selling to like the worst market possible. Or how do you view them? Like they can easily pivot to just sell to AI companies, and so as long as they figure the product out, they'll be fine. They're just adjusting to ICP.
I saw that question and I had to laugh because it just reminded me of being in the sponsor area of SaaStr. And it was just literally the only people that were in the sponsor area were the sponsors selling to other sponsors. That's what
those are
we
great.
all did. We
The
crushed it.
heyday, 2020, 2021, 2022.
2021, SaaStr was
Oh, baby.
lit. It was awesome. I think that's an old school thinking. I don't think that that's as true. That is the YC Blitz scaling Reid Hoffman point of view, where you have Sequoia Excel companies selling to other Sequoia Excel companies to get off the ground and get traction, and then find product market fit through that, and then find enterprises and blah, blah, blah. I don't think that that's actually how companies, even SaaS companies, have been built in the last 3 years. I think the rise of vertical SaaS has really changed that. And I think that that's just kind of a, a small window. I do think that that is part of the reason why HubSpot stock has taken us just a beating, is because their market have been SMB tech companies that are getting up and running through marketing inbound. And that's changed, obviously AI, but I don't agree that that's how, like, that's a indicator of the market today. I think it's just, a symptom. It's not what we do. We're 50% of our customers are tech enabled today, which I think is a lot lower than it was 3 years ago. It was 80%.
Well, I hope you listen next week, everybody, when we reveal a very special secret about my personal life. Please make sure that you listen. Thanks for listening to Topline. Give us 5 stars on the Spotify and iTunes stores and smash that subscribe button on YouTube. I really do think you should join our Topline Slack community. Thanks to all of the people that are much more active recently: Jackie, Jessica, Asher, of course, Ryan Burke, Charlie Moss, the people that I mentioned regularly, Marius Andre, and anybody else that's new and active. Get inside our Top Line Slack community. It's where all the fun happens. Thanks for listening, everybody.